our core scenario is that China will continue to slow down. To make it very, very simple, in the last 10 years, they have had a lot of public investments. These public investments have to be reduced. They have to address shadow banking, credit bubble, which means that, frankly, we keep and we stick to a relatively pessimistic stance for Chinese growth for the next few quarters. Absolutely. In fact, you're right. What is very, very interesting is that, if I may say, the worst it will be on GDP growth, the most likely they will have to do something in terms of stimulus. And this will be extremely positive for Chinese markets, risky assets, and equity markets as well. What is interesting is that on any metrics, this market has been underperforming the last few years. Whatever you take from a yield standpoint, from an interest rate standpoint, from a discounted cash flow standpoint, this market is cheap. Now, next question mark, is it because it is cheap that we might have a rebound? I think we're not so far from this. To be frank, it remains quite limited, but where it's a kind of catch-22 situation, the Chinese government needs obviously to open far more their assets than what they are doing right now. And they need also to give a kind of carrot to investors. And at this stage, what we have had only the stick with the downside in the market. But let's be patient, and certainly this market should recover. To be frank, you would not be surprised, but it's on one side property and on the other side commodities.